Welcome back to Talk Tickers. It is Monday, January 26th, 2026.
And we've got a really classic earnings season paradox to unpack today.
Exactly. The kind we love to see. A company absolutely smashes the headline numbers. The press release looks amazing.
And then the stock gets hammered in after hours. The old beat and drop, it's a classic.
This one is Sanmina Corporation, ticker symbol SANM. They just put out their Q1 fiscal 2026 results.
And the reaction was pretty violent. The stock closed the day around $182.50 and then just poof, dropped almost 8% after hours.
So that's our mission today. We need to be forensic accountants here. Why does a great quarter lead to a sell-off? Is the market right to be spooked, or is this an overreaction?
Let's dig in. I think it's all about the gap between the backward-looking numbers and the forward-looking ones.
Okay, so let's start with the good stuff, the numbers they just printed. Because honestly, they were a monster beat.
They really were. Let's start with the bottom line. Non-GAAP EPS came in at $2.38.
And the consensus on the street was what, like $2.15?
Yeah, around $2.15. So that's a solid, almost 11% beat right there. But the really wild part is the year over year. A year ago, they did $1.16.
So they more than doubled their earnings per share in 12 months. That's incredible leverage for a hardware company.
It is. And the top line, the revenue, was even more of a headline grabber. It hit $3.19 billion.
Beating the consensus of $3.10 billion, but the growth rate is the crazy number here. That's a 58.9% year-over-year increase.
59%.
You just don't see that, not from a company like Sanmina, which has historically been this, steady industrial manufacturer.
Well, and that's the first clue, right? This isn't the old Sanmina. This is the first quarter where we're really seeing the impact of the ZT Systems acquisition that closed late last year.
Right, which we're going to have to dive deep into, because that's where all the nuance is. But one last number before we move on. Margins. Did they keep it together?
They did. And this was, for me, the most impressive part. Non-GAAP operating margin held steady at 6.0%.
6%. That's their target, right?
It's their gold standard.
And normally when you swallow a huge acquisition like ZT, you expect some, indigestion. You expect margins to dip for a bit. The fact they held that line is a testament to their operational discipline.
Okay, so just to recap, huge revenue beat, EPS more than doubled, stable margins. At 4 p.m., if you own this stock, you are feeling great.
You're popping the champagne.
And then the market closes and the floor just falls out. Yeah. So what's the disconnect? It has to be the guidance.
It's all about the guidance.
Yeah.
But to understand why the guidance was so scary, we have to do a little back-of-the-napkin math on that revenue number.
Let's do it. We know the ZT Systems acquisition is driving the growth. This is their big pivot into becoming an AI infrastructure powerhouse.
Exactly. And the segment data shows it's working. Communications networks and cloud and AI infrastructure now make up 62% of their total revenue. The company's DNA has changed.
And on the call, the CEO, Yuri Sola, said the core Sanmina business, even without ZT, grew about 20% year over year in that segment. Right, so the organic engine is still humming along. But here's where the math gets tricky. And this is what these sophisticated investors, the algos, are all over.
Okay.
That Q1 result, that big $3.19 billion number, it only included 2 months of contribution from ZT Systems.
Only 2 months, because the deal closed at the end of October.
Right. So you've got this monster revenue number, but it's only got 2/3 of a quarter's worth of your shiny new asset.
Mm-hmm.
So as an investor, what are you expecting for Q2?
Well, Q2 will have a full 3 months of ZT. So logically, revenue has to jump sequentially. You're adding a whole extra month of a massive business.
You'd expect a stair step up, a big one. You just take the daily run rate of ZT, add 30 days of it.
Yeah.
And your Q2 revenue should be way higher than Q1.
But I'm guessing that's not what happened.
That is not what they guided to. Not even close.
I'm looking at the guide now. For Q2, they're forecasting revenue between $3.1 billion and $3.4 billion.
And the midpoint of that range is $3.25 billion.
Wait, hold on. They just did $3.19 billion with only 2 months of ZT, and the midpoint for a full 3 months is only $60 million higher.
And that's it. That is the math that absolutely terrified the market. That's why the stock dropped 8%.
Because that implies something is wrong. Either ZT is slowing down dramatically, or the core Sanmina business is falling off a cliff to offset the gains.
Exactly. It implies a sequential deceleration in the daily run rate. And an analyst on the call from BofA asked this exact question. He basically said, why is revenue flat if you're adding a whole month of ZT? It was the elephant in the room.
And what did management say? Did they have a good answer?
Not really, to be honest. Their defense was very much, hey, we're just guiding one quarter at a time. They said the business is improving, that core Sanmina should grow high single digits for the year. And they didn't give a clear bridge to explain that math.
So it's a trust us story versus a spreadsheet that says this doesn't add up.
And in this market, the spreadsheet always wins, especially with anything related to AI. Any hint of a slowdown, and people hit the sell button first and ask questions later.
And there's an inventory angle here too, right? I saw that number and my eyes popped. Inventory was up 74% year over year.
To $2.2 billion. It's a huge number. Now, the CFO, John Faust, explained this is purely the ZT integration. They basically took on all of ZT's inventory.
Okay, but that's a lot of cash tied up in parts.
It is, and the partial quarter math hurts them here again. In this business, you measure efficiency by inventory turns. Because they booked all the inventory but only 2 months of sales, their turns dropped to 5.3 times. It looks inefficient.
So it looks like they've got all this stuff on the shelves and they aren't selling it fast enough.
Right. It distorts the metrics. They say it'll normalize with a full quarter of sales, but you combine a 74% inventory spike with a flat revenue guide. And it paints a picture of a company that might be a little backed up.
Okay, so that's the bear case. That's the ugly. That's why the stock is down. But if you zoom out past the next 90 days, there were some really interesting hints about the bigger picture here.
Absolutely. If you can ignore the noise of the Q2 guide, the long-term story is actually really bullish. Their goal, stated on the call, is to double the company's revenue in 2 years.
To a $16 billion run rate by calendar 2027.
Which is a huge claim.
Yeah.
And it's all riding on this AI hardware narrative. They're shipping 400G and 800G networking systems. And they even said they're starting to ship 1.6 terabyte systems.
Okay, so that 1.6 terabyte number, why is that so important? For the listener who isn't a network engineer, what's the big deal?
It's the new speed limit for the data center. It's that simple. The bottleneck for training these huge AI models isn't the GPU chip anymore. It's the plumbing, the switches and cables that connect them all. 1.6T is the absolute cutting edge.
So by making those, Sanmina is basically inserting itself into the most critical part of the AI build-out.
They're moving up the food chain. They aren't just a build-to-print shop anymore. The ZT acquisition brought in design and engineering talent. They can go to the hyperscalers and help design the whole rack, the cooling, everything. It's a much stickier business model.
So they're becoming this one-stop shop for building data centers. But there's another piece of this that really caught my ear. They spent a lot of time on the call talking about Houston.
Yeah.
And building transformers.
This is the hidden call option in the stock, I think. The thing the market is totally ignoring right now because they're so obsessed with the Q2 guide.
Go on.
Look, everyone knows you need GPUs for AI. But you can't run a GPU without electricity. And you can't get the electricity from the grid to the data center without massive transformers and switchgear.
And right now, the lead times to get one of those transformers are, what, like 2 years? It's a massive bottleneck.
The grid is the bottleneck. So what is Sanmina doing? They're quietly building a massive factory in Houston, Texas to build their own energy products. They're partnering with a Croatian company called Konichar.
So they're going to build the things that power the data centers that they are also building. It's vertical integration for the power supply chain.
That's exactly what it is. And they said they expect to be shipping units late this year, 2026, with full production in 2027.
That timing, 2027, that lines up perfectly with their $16 billion revenue target.
It's the second wave. Wave 1 is the AI racks. Wave 2 is the infrastructure needed to power them. It's a brilliant long-term strategy.
But we have to be realistic. That's a 2027 story. Right now, investors are looking at their legacy industrial business.
The IMD segment, yeah, industrial, medical, defense. And that was down 3% year over year. The automotive part was particularly weak.
They use the word stabilizing, which is CEO speak, for it stopped getting worse.
Right. So you have this shiny new AI business, but it's still attached to this older, slower, cyclical industrial business that acts as a drag.
Okay, so that brings us to the most fun part of the show. We've looked at the numbers, the guidance, the long-term story. Now let's talk about the trade.
And it is time for our favorite disclaimer.
That's right. This is the part of the show where we pitch an idea that is absolutely, positively not financial advice. We are not your advisors. This is for entertainment. This is a thought experiment.
Think of it as a wild pitch at a hedge fund meeting after too much coffee.
Okay, I'm calling this trade the Transformer AI Arbitrage.
All right, I'm intrigued.
The thesis is this. The market is myopically focused on the messy Q2 guidance math. They're missing the bigger story, which is that Sanmina is about to become the toll booth operator for the entire data center power grid through that Houston factory.
So you're betting on the bottleneck itself.
I am betting on the bottleneck. So the trade structure is this. You go long Sanmina, ticker SANM.
Okay, the simple part. What's the hedge? How do you make it an arbitrage?
You pair it with two shorts. First, you short the copper ETF. Copper is the raw material. It's cyclical. If the global economy slows down, copper gets hit. But the demand for Sanmina's specific transformers stays high because of AI. You're isolating their manufacturing value from raw commodity risk.
Interesting. Okay, what's the second short?
You short the utilities select sector, the utilities themselves.
Now, why would you do that? Everyone thinks the utilities are a huge winner from AI power demand.
Because they're regulated, they have to spend billions and billions in capex to upgrade the grid, which crushes their free cash flow. But they can't raise rates on customers fast enough to pay for it. And who do they have to pay all that capex to?
To companies like Sanmina who are building the hardware.
Exactly. You're betting Sanmina extracts all the profit from the energy build-out, while the raw material guys and the regulating utilities get squeezed. It's an outrageous structural bet on a manufacturing bottleneck in Houston in 2027.
It's a bold thesis. It completely looks past the next few quarters of guaranteed volatility and bets entirely on that factory ramp. I like the logic, though.
So there you have it, the transformer AI arbitrage. Again, not financial advice, just something to think about.
I like it. It connects the dots in a way the market isn't right now.
So let's wrap it. Sanmina. A monster Q1 beat driven by AI and the ZT acquisition, but murky, confusing Q2 guidance caused a big sell-off.
The company's changing its DNA right in front of us. It's going to be messy. But the long-term targets, the energy play, that's all still intact. Today's volatility is just the price you pay for that kind of transition.
It's definitely one to watch if you can stomach the swings. We'll be keeping a close eye on that Houston factory ramp.
And of course, do your own homework.
We'll catch you on the next tick.